Hello there. Well, the good news since our last update is that the Omicron variant of COVID-19 that we were all so worried about, at the moment looks like it's less serious than perhaps we had first feared, or at least it is having less of a serious economic impact than we perhaps first feared. We've just heard today, as I record this, that the government is going to do away with the Plan B regulations they introduced late last year, and so some of the restrictions on what we can do will subside. So that obviously is a positive from an economic effect, and this kind of good news about the variant has means a lot of people are more optimistic about the economy, and that's one of the reasons we've seen the FTSE 100 go up quite well since the start of this year. Because it has a lot of the companies within it that were hit quite hard by the pandemic. Things like the oil and gas giants, things like banks, and some of the leisure stocks, for example. So the FTSE is doing quite well. But as the economy recovers, attention is turning to what the central banks are going to do, particularly in light of the very high levels of inflation we've currently got. And central banks are putting up interest rates, and they are probably going to put them up much more quickly and more steeply than many investors had thought last year. And that means at the moment, bond markets are really struggling. Bonds tend to do poorly when interest rates go up. But also some other parts of the stock market are struggling because of the same thing. For example, some of the US stocks, which did really well towards the back end of last year, in fact, really outperformed everything else last year, have really struggled since the start of 2022. They tend to be quite sensitive to what's happening in interest rates, and so they're starting to fall. So it's been a really interesting time. We are seeing a bit of what we call a rotation in the market. Some of the things that previously were doing well are now starting to struggle. Some of the things that were struggling are now doing quite well. So it makes it quite difficult as an investor, because we're trying to be well diversified and have a bit of everything and not bet too much money on any one outcome. Some things are doing very well, some things are doing not so well. So we're trying to get the balance right between the different parts of the market and the different asset classes to try not to be too hit too hard if for example some of those US stocks carry on falling, or if rates go up more quickly than people think. So lots going on at the moment. But with the FTSE doing so well, then at the moment we've got fingers crossed that some of our defined returns products will kick out in the next few months, and that should be a positive for returns. And then of course attention turns to where we look to reinvest the money should we get some kick out. And generally we're going to try and diversify some of that money, some of it into equities, some of it into what we call real assets like property and infrastructure that tend to do well with inflation. And some of it we'll probably keep aside in lower risk assets just in case the markets do have a bit of a pullback. So as I say, lots going on under the surface, lots of volatility in markets at the moment. And as ever, we have to be quite careful what we do and ready to react. Thanks very much.